begin with a health check. Now, how are we doing in terms of our macro stability indicators? And this picture, I thought, spoke 1,000 words. We have spoken a lot about reserves. When we see reserves in isolation, that tells us half the story. But when you compare it with our vulnerability points, that's essentially short-term debt, or we compare it account our current account deficit, you can see that it's a positive gap. Our reserves has the ability to absorb a lot more shocks, be it homebound or exogenous. There is a sufficient and more cushion, and I think this is continuing to improve as we go along. The other one is, of course, public debt. Certainly, so this is one of the reasons why we have been not rewarded with a rating upgrade, particularly because our fiscal debt levels are still quite high. But we do think that in the next 5 years, for instance, our public debt as a percentage of GDP is going to come down to towards 80-81%. So which will again tick some of the boxes for the rating agencies, and henceforth we do think that an upgrade is coming as well. So in terms of our macro stability indicators, in terms of our fiscal health, we're certainly on the mend. I think on the macro stability fine, I think we are more than enough cushioned. So we don't anticipate our ability on that front, especially on taking in any shocks or uncertainties. Then we take it to the second point, which is capital flows. Again, important that we consider portfolio flows and we consider the stickier FDI flows as well. As you can see, the gross FDI has come down, but it's still been relatively stable on the year when we talk about fiscal 24 and 25. Next question asks, where is all this money going? And I think that might be useful for many of you. So, it is concentrated a lot into services at this point, but as you can see, the share of the other real sectors has also been going, increasing. And I do think something like renewable energy, power, food processing are some things that will move up the value chain in the coming years. So as the government's intentions goes much more towards, and we already, infrastructure, capex, and all of that is already underway. I think there'll be more and more FDI, foreign interest, into this field apart from manufacturing. So on the FDI front, certainly well oiled. It's been, it's coming into certain sectors much more, but I think it will get more balanced as we go along. So that's on the foreign flows. If we look at the portfolio flows, also foreign flows, you can see that in debt and equity, you have seen quite a bit of inflows over the past, say, 2 years at least, and much more in the debt in the past year. And good part of that has also got to do with the fact that we are, being already started, the process has already started in making us a part of the global indices. The first provider has already included us as of June. The next one that's coming is in January of next year. A lot of stock checking happening right now in the first month of index inclusion. How much dollars have come in? Is it 300? Is it 1 billion? Is it 1.5 billion? I think the only response to that is it's always been a very gradual process. We have got examples in Chile, in China, in Indonesia, where the index inclusion does not mean if there's a spurt. It's a very gradual process, because as weights go up, so does the quantum of inflows. So we are quite hopeful that anything between 15 to 18 billion is likely to come in over the course of this 1 year. So this was portfolio flows and the investment flows. Then we come to credit growth. Now credit growth, of course, at the headline level, there's a lot more subcomponents. I've just included industry here. And I've included, split it by, in terms of what kind of industry these are. Are they medium, small, or large? And you can see most of them, especially for the MSMEs, it's kind of flatlined in the past year. But medium enterprises, there's been a pickup. Again, where is this going? Which of the sectors are growing at a faster pace in the past year and going into fiscal 24? These are some of the sectors that stand out. I've picked these because these are also the heavy, it's not only the sectors that are growing fast, but they're also the bigger sectors in the bank's books and on an aggregate basis. So here too, you can see that funding from offshore, financing from offshore, as well as domestically, has picked up in the past 3-4 years. So we do think that this will continue to happen even more as we go into, as the growth gets stronger, more and more sectors will stand to benefit from access to finance. Then the next one being on ECBs. we have seen ECBs that had slowed down during the phase where rates had gone up globally. But again, since about mid of last year, we have seen quite a significant pickup in ECBs. And here I want to show where is this going, right? We don't just stop at the headline level. We dig one level deeper, and what are the purpose for which ECBs have been taken. So certainly you've seen a mix here, on lending, sub-lending being one of the main ones, and there's new projects, which is very encouraging. And there are also some of the earlier ECBs being refinancing. There's also this gap between onshore lending and offshore lending that has turned in the favor of ECB. So that too has been another factor why it's picked up in the past 1 year or so. So funding, financing-wise, foreign flows as well as our local flows, I think has been quite strong and moving in the right direction, especially when it comes to investment as well as short-term flows. I finish off by just giving you a sense of what our rate and rupee expectations are. And for rate expectations, I think this is something that might be Governor Das's favorite chart, which is showing you that since starting of 23, what has contributed the most to our inflation. And I've given, this is over a period of time since about beginning of 23. And you can see the sector or the segment that's risen by the most is the food segment, while services, core, and all of that has been quite contained. So food is certainly one of the main reasons why inflation has been held up. Thankfully, inflationary expectations are still very manageable, right? They're still falling. They're still quite low. I think at this point, the central bank is in a steady place in terms of wanting to keep rates on hold. They do see some problematic areas. I think they've taken macroprudential measures where required, but they've opted not to, either hike nor cut. So I think it's a path of least resistance, so to speak. And we think this will continue for the rest of the year. We don't anticipate the RBI to lower rates until the end of 2024, even if we have a call that the Fed will cut rates. So we expect the RBI to actually hold on for longer than that. Final part is on the FX. And before I talk about the rupee, I thought I'll just probably 10 seconds on the dollar index. Dollar moves a lot up and down, but I think if you see, take a step back and see, it's been largely range bound. It's been in the 103 or 104 to 106 range. Going into going into the rest of this year and to next, we expect a bit of a moderation in the dollar index, not too much. And again, that's going to be a byproduct of what the Fed is doing. But I don't think the Fed cuts alone are enough to be very negative on the dollar. I think you can expect some depreciation, but it's going to be very modest, going towards 102, 103 on the dollar index. On the rupee front, volatility has been, I'm sure all of your trading counterparts have also been telling you, volatility has been very low. In fact, lowest among many of the other currencies that we monitor. And that makes us believe that the dollar rupee, in fact, is likely to be closer to a shade under 83 by end of this year. So we don't expect a very sharp appreciation in the currency. On the back of the dollar move, we think that the rupee could be slightly stronger. That's about 20-30 paisa from where we are at this point.